Having international funds in your portfolio is a highly debated topic. Some say it's really not necessary. Others say you're missing out on some great exposure by not including them in your portfolio. So in this video, we're going to get to the bottom of this debate. 1. Do you really need international funds in your portfolio? We'll hear both sides of the argument. 2. If you decide that international funds are something you want, how much is appropriate? And finally, what is the best international funds to hold? If you want to save some time from watching the rest of this video, let me give you the 5-second takeaway. Yes, I believe it is a good idea to hold international funds in your portfolio, but no more than 20%. And when it comes to a specific fund, buy VTIAX, Vanguard's Total International Stock Index Fund. Alright, if you're still with me, thank you guys for sticking around. If you're new to the channel, my name is Tay from Financial Tortoise. In this channel, I discuss personal finance, investing, and another very interesting topic, surviving a multi-generational family. If these topics sound like something you want to learn more about, I would much appreciate it if you could consider subscribing and also hitting that like button. And if you have yet to download your free copy of the Sandwich Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future, please go to my website at financialtortoise.com and do so. I send out weekly newsletters with other great tips on mastering your money, and I wouldn't want you to miss them. So the first question we want to ask ourselves is, why even invest internationally? Many of us are probably not as familiar with names of companies outside the United States. Yes, we've all heard of Apple, Google, and Tesla. But how many of us can honestly say we know much about companies like Taiwan Semiconductor Manufacturing Company, aka TSMC, Tencent Holdings, or ASML Holding? But would you be surprised to know that some of these companies rival the size of many major US-based corporations in market capitalization? TSMC is a Taiwanese multinational semiconductor contract manufacturing and design company and is considered the world's most valuable semiconductor company. Tencent is a Chinese multinational technology and entertainment company and is considered the largest company in the world in the video and the gaming industry. And ASML is a Dutch multinational corporation specializing in development and manufacturing of photolithography system. I honestly don't know what that means, but it sounds pretty fancy. So at the end of the day, when we're only investing in US-based companies by holding only US-based stocks, we are potentially missing out on the portfolio growth that these international companies can provide. In addition, markets outside the United States may not always rise and fall at the same time as a domestic market. So owning pieces of both international and domestic securities can level out some of the volatility in our portfolio. But as with anything in life, there isn't just one viewpoint. I do want to share with you some strong arguments that argue against international funds in your portfolio that you want to consider in your decision making. Jill Collins, one of my favorite authors who wrote The Simple Path to Wealth, actually argues in his book that you don't necessarily need international funds in your portfolio. One pretty good argument that I actually agree with is due to accounting risk. Accounting is not a sexy topic, but you do have to give it to America's accounting standards. Compared to many other countries in the world, especially emerging countries, America's accounting practices are top-notch. When companies produce their quarterly and annual financial reports, they need to adhere to strict accounting policies. I've worked with many accountants in my former life, and trust me, they may not be the funnest bunch, but they do take their accounting policies seriously. Many other countries do not have the same level of transparent and strict accounting standards that's required here in the US. So what this means is that when we review Apple's latest annual financial report, we can have a strong confidence that what they report is actually accurate and honest, vetted by top-notch accounting firms. But when it comes to financial reports from other countries, it's a risk to apply the same level of confidence. Another key reason Jill Collins cites for not needing international funds in your portfolio is that the world economy is a lot more integrated today than ever before. Many of the major US-based companies today aren't just domestic companies, but they are actually international corporations. They generate a good percentage of their sales and profits overseas. For example, just look at Apple, the biggest US company based on market capitalization. As of the second quarter of the fiscal year 2021, 67% of Apple's total revenue was generated from outside the United States. At one point, there were more Chinese people purchasing Apple products than there were Americans. So the argument here is that when you hold US-based company stocks, you already have access to growth of the world market and are able to gain the benefit of that growth. But again, we live in a complex world and this is one viewpoint. Your viewpoint could be different, and some argue that having international exposure can actually be quite worthwhile. The Bogleheads, famous for their intense devotion to Jack Bogle and his index fund advice, have a slightly different perspective when it comes to international funds. Of all the stocks in the world, the US stocks represent about half of the world's stocks. 33 trillion of the world's 68 trillion total stock market value, or about 49%. In one of their books, The Boglehead's Guide to Investing, they argue for international stocks by referencing the Japanese stock market. At the end of 1989, the Japanese stock market's capitalized value was considered the largest in the world. The Nikkei 225 index, the index of 225 largest publicly owned companies in Japan, reached an all-time high of close to 40,000. Sadly, 22 years later, the Nikkei was under 8,500 and to this day has yet to reach its all-time high again. But sadder is a Japanese investor who failed to invest in international stocks outside of Japan. The US-based companies are currently the world leaders in market capitalization and revenue. But who can confidently say it will stay like that in the future? It would be unfortunate, but the same thing could happen to the US stock investors. I personally still have strong confidence in the US economy and US-based companies as a whole, but I also have to continuously check my assumptions. Financial writer Larry Swedroe had a saying, "Never treat the highly likely as certain and the highly unlikely as impossible." The bottom line on holding international funds in your portfolio is this. It depends. I know, it's unsatisfying. I hate it when people say this to me, but in this case, it's so true. So much of it is based on your appetite for risk and your worldview. And the world outside the United States is a big and complex place. And there are quite a few things you want to consider when thinking about the international market. One of them being that when we're talking about the international market, there are actually several types of international markets. To simplify, international markets are generally divided into two categories: developing markets and emerging markets. Developed markets, as the title suggests, are in countries that have established industries, strong infrastructure, and in generally relatively high cost of living. Think of countries like the United Kingdom, Japan, and Canada. Emerging markets, as the title suggests, are in countries that have less stable economies and still developing capital markets. But many of these countries are on the pathway to becoming a developed market, so they have faster growth and thus potential for higher returns. Examples of emerging markets include countries like India, China, and Mexico. So when looking at international funds, we want to check to see what percentage of the allocation is weighted towards developed markets versus emerging markets, because this will affect risk and return. We don't want to be weighed so heavily towards emerging markets given the volatility in these regions. And vice versa, we don't want to be only weighed towards developed markets given we're missing out on potential returns. Location is another factor you want to consider when thinking about investing internationally. Though we're living at a time when more countries, regardless of their location, are more tightly integrated than ever before, regional events still have impact on their specific regions. A Europe-based crisis will have a strong impact on European countries. And similarly, a Latin-based event will impact countries in Latin America. So when assessing an international fund, you want to be wary of its allocation to different international regions. You don't want a fund that has a 90% of its allocation to Antarctica, unless you strongly believe whaling is going to make a comeback. And to add another complexity to your international fund decision, there are many different types of international funds as well. There are international funds that invest only in foreign markets, excluding the United States. There are global or world funds that invest in essentially everything, both foreign and US markets. Regional funds invest primarily in specific regions of the world that we discussed earlier, like Europe or Latin America. Developed market funds invest only in developed foreign countries, and emerging market funds invest only in emerging foreign countries. Alright, now that I've done enough to confuse you about the world, let me give you my simple recommendation and what I personally do when it comes to investing internationally. If you still have the desire to invest in international companies after all that I talked about in this video, buy VTIAX, Vanguard's Total International Stock Index Fund. It's my go-to fund that represents close to 8,000 non-US based companies. All international companies that we may have heard of, such as Samsung, Shell, and Alibaba are in it, and thousands of others we may have never heard of. VTIAX has an expense ratio of 0.11%, and like many other Vanguard funds, has a minimum investment requirement of $3,000. It also has an ETF equivalent, which is Vanguard Total International Stock ETF, VXUS. And in order to mitigate the risk of different markets and regions in the world, it has a good balance of emerging versus developed market holdings spread all around the world. And I don't know about you, but it feels pretty cool to say that I own a piece of overseas companies like HSBC and Unilever. Now, when it comes to how much to hold, the generally agreed upon number is approximately 20%. Jack Bogle recommends no more than 20%, and Vanguard recommends at least 20%. So as a compromise, I think 20% is a good place to start. It's meaningful enough to make a difference in your portfolio, but not too much to hurt if foreign markets start to fall out of favor. And you always have the ability to increase or decrease your exposure based on your comfort level with international stocks. There you have it, guys. If you debated having international funds in your portfolio, have no more. If you like the idea of having some international exposure, buy VTIAX and hold up to 20% of your portfolio. But if you don't feel comfortable holding international funds, no worries either. Gerald Collins would give you his approval as long as you're holding well-diversified total market index fund as your core holding. Thank you guys for watching, and until next time, all the best.